Just looking at the big picture here, it seems like consumers are still interested in buying things, especially big ticket items. And indeed, we asked them, what share of you plan to buy a big ticket item over the next 6 months? And 46.4% said yes, and 21% said maybe.
You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Mitchell Barnes, labor markets economist at the Conference Board and guest host of today's episode. In today's conversation, we'll discuss the U.S. Consumer Confidence Index for December, as well as our outlook for the global economy. Joining me today is Dana Peterson, chief economist and leader of the Economy, Strategy, and Finance Center at the Conference Board. Welcome, Dana.
Hi, Mitchell. It's always great to be here.
And let's just dive right in. What was the biggest takeaway from the December U.S. Consumer Confidence Survey?
The biggest takeaway is that in December, consumers were less happy. We had two very strong months of confidence, and indeed, earlier this year, confidence wasn't that great, but it picked up. But it seems like for December, there was a little bit of lack of Christmas cheer, if you will.
And I think that is a great tie into the holiday spirit here. And what really happened with the index this month, and how does that really relate to what we've seen?
Absolutely. Well, the present situation ticked downward a little bit, but it was mainly expectations. Expectations fell pretty sharply back towards 80. And 80 is important because that's usually the threshold under which consumers expect there will be a recession at some point within the next 6 to 12 months.
Mhm. And really looking under the hood as we really look to some of the age groups and income breakouts that we are able to see, what do you see there as maybe the story?
Well, the interesting thing is that people 35 and under just generally are happier than all other age groups. And in the month, their confidence ticked higher, but confidence for the other age groups ticked down. But we know this is a very volatile series, and so we smooth it out. And so, on a 6 month moving average basis, it's still the case that people of all ages are generally happier now than they were 6 months ago. And the same thing about income. And indeed, when it comes to income, typically the people who have the most money are the happiest. But overall, in the 6 month moving average, people are still much more optimistic now than they were before, despite the little bit of a downtick or at least a pullback we saw in December.
And when you really extrapolate away from really those expectations, when you really drill down into some of the ideas around recession and anticipation there, what do we see going into next year?
Well, the interesting thing is that consumers really aren't convinced that there will be a recession. In fact, we do ask them point blank, do you expect the US to be in recession at some point over the next year? And the reading in December was pretty close to what we saw in November, and November was an all-time low. Now, we've only been asking this question since July of 2022, but we did see a pretty strong run up during the worst of the inflation period. So consumers are seeing that the rate of change in prices is slowing and also they're working, and so they don't really anticipate recession going forward.
And as they think about, that inflation trajectory going into next year, how do they feel about those prices? Do they see that trajectory kind of coming more in line with what policymakers would like to see?
Actually, yes. In terms of the 1 year inflation expectations, both when you look at the median and the median is just lining everything up and picking the middle one. Inflation expectations are back where they were before the pandemic. So roughly around, January 2019. So that's really great after inflation expectations surged while we saw a big spike in inflation as we were recovering from the pandemic. So that's really great news that in general, consumers think that inflation is going to continue to cool. However, with respect to write-ins, inflation and prices were back at number one in terms of the things that they were citing that would have an impact or that's currently having an impact on the US economy. And that's after elections kind of popped up in November. But even after inflation, elections were second. But for the most part, consumers are still very much focused on prices, not only how quickly they're rising, but also the price level. Indeed, most things cost more now than they did before the pandemic.
Absolutely. And we know that that has been on the mind of consumers for quite a while. And as we look to next year, we've seen, really enthusiasm in the stock market. Obviously interest rates are, perhaps not cooperating with what we would like to see. But what are consumers feeling about really those markets going into the year?
Yeah, it's still the case that in general, consumers believe that markets, or at least the stock market itself, will continue to rise over the next 12 months. I mean, there was a little bit of a pullback in some of the enthusiasm, but it's still near, all-time highs in terms of what they're thinking about the stock market. They're expecting that it's going to continue to rally and that they'll benefit from it either because they own stocks or because they see that as a signal that the labor market is strong because businesses are doing well.
Sure. And I think really what we see in all of this sentiment, we really look to boil down and really how do they feel about their own household finances today? Really capturing both this employment and inflation sentiment that they see. What are kind of their present situation, sentiments around their own household finances?
Yeah, it's interesting because when we look at the present situation, it's made up of two measures: business conditions right now, and also the ability to find a job easily right now. And in December, consumers continue to think that yes, it's pretty easy to find a job right now. They were more concerned about business conditions right now. But when we look at finances right now, um, there was a little bit of a pullback. Indeed, they still on net think that their current finances are good, but they're a little less sure. And that could be a function of a number of things, but certainly in terms of being able to find a job, which is important for holding up those consumer finances, they're happy. But I would note that it could be the case that the finances is capturing the inflationary piece. Indeed, as I mentioned, inflation popped back up. And when we look at the CPI and also the PCE deflator, they've been a little stickier than we'd like them to be. So maybe that's showing up in these financing, their views about current finances.
Certainly. And the holiday season, I think that brings it home for many. And, I know you had mentioned, a few moments ago, the election uncertainty, some of the, sentiment coming into the last several months. Were those really apparent in some of the write-ins and some of the data that we got this month?
Yeah, so after inflation, write-ins about elections, about the White House, about the president, about what's going to happen next year in terms of taxes, all of those, and also tariffs. There was a big jump from zero to something slightly positive in terms of mentions of tariffs. So consumers are very focused on what the political environment will look like for next year, and they do believe that it will have an impact on the economy.
And has that started to translate into, any behavioral changes? Obviously there was a lot of anticipation going into the election. Have we, seen any data come out in the last several weeks that really gives us an indication that consumers have changed kind of their buying patterns headed into next year, given the circumstances?
Well, we did receive retail sales about a week ago, and they were still really strong, both in terms of nominal spending and real spending. And we saw a little bit of a pick back up after October. We know October was impacted by two hurricanes that smacked into the southern eastern part of the U.S. And it seemed like people began to recover from that, and people were still buying things in November. In fact, anecdotally, both Black Friday sales and Cyber Monday sales were really strong and may have hit, new highs in terms of how long people have been tracking them. And so it's not really clear that the election itself cause people to spend less. If anything, just anecdotally, you've been hearing people in the news saying, well, they're stocking up ahead of, what may happen next year if there are tariffs and things like that. But in general, I think unless the results of the election really hit their bottom lines, impacts either their jobs or their incomes or their taxes, consumers are going to spend no matter what, and that seems like what's happening here.
And that seems like continuation of what we've seen is really the trend over the last year. And I know something else we've been tracking really inside these buying patterns is really the shift of durables to services, perhaps back to durables. Is there anything within that data that might give us an inclination of the path ahead?
Just looking at the big picture here, it seems like consumers are still interested in buying things, especially big ticket items. And indeed, we asked them, what share of you plan to buy a big ticket item over the next 6 months? And 46.4% said yes, and 21% said maybe. So if you want to look at maybe in the positive sense, if you add that all up, it's close to 70% of consumers are planning on buying some big ticket item. So what's a big ticket item? A car, a home, appliances, some expensive high tech thing. And so that's definitely the case. But it still also is the case that consumers are looking to buy services. Indeed, 40% said yes, and 19% said maybe. So it's a little less strong in terms of buying more services relative to some big ticket item. But it's clear that consumers are willing to spend money. And when we look at the big ticket items, things like cars, for the most part, you still see this increase in the percentage saying they want to buy a car within the next 6 months, and they're looking more to buy a used car as opposed to a new one. It's always the case, but we've been seeing some new car buying intentions pick up after reaching kind of a nadir in the springtime. And also, consumers are looking to buy a home, a few of them, but that's still pretty weak. It's still pretty weak, and that's because home prices are very high and mortgage rates have actually increased despite the fact that the Fed has been cutting interest rates. And then looking at services, it's the case that consumers are still very much focused on experiences. So the number one service they plan to spend more money on over the next 6 months is restaurants, bars, takeout, also streaming. Interestingly, things like beauty and personal care popped up, as well as in hotels and motels were still pretty high. In terms of healthcare, that moved up. I would say healthcare is more of a non-discretionary item, but for the most part, consumers are still looking to go out and splurge on the things that they like to do that have some kind of good feeling or an experience.
Well, that's great to know that the consumer is certainly backed by the strong labor market, are continuing to power the economy forward. And I know we had, already mentioned the strong, at least indicators that we've gotten from Black Friday and some of the holiday spending and sales. But, what have we already seen, from some of the early data on vacations, travel, some of the, experiential trips that I think you mentioned coming into this holiday season?
Yeah, I mean, the thing is that vacation intentions to go on vacations have actually come off. We reached a post-pandemic peak around February of this year. We never actually returned to the pandemic level in terms of people saying they were going to go on vacation, but we did reach a local peak post-pandemic in February 2024. But since then, it's been trending downward,
Hmm.
and now the latest reading. And actually, we used to ask this question every other month. Now we're asking the question every month. And it's back towards where we were around the fall of 2023, which was still better than the worst part during the pandemic, but still in all, it seems like some of that vacation fervor is cooling off. Nonetheless, for those who do plan on going on vacation, it's still the case that people would prefer to travel domestically than abroad. But the number of people, at least the share saying they want to travel abroad, continues to improve. In fact, it's probably the best that we've seen in a long time. And I'm looking at this graph that goes back about, 10, 15 years, and it's still the best reading over that period of time. But certainly when it comes to domestic travel, which is the most likely travel, that has come off. So I think that, designs to travel domestically is really weighing on the overall question about whether or not people want to travel. So I think this is important, especially since we know people over the last few years have been doing revenge travel and after being cooped up during the pandemic and going on 2 and 3 vacations, it looks like some of that is cooling off and people, might have gotten their fix in and they're going back to some normalcy in terms of their desire to travel.
Sure. And I think that is a trend that we will certainly be watching going into next year. And before we take a short break, Dana, is there anything else you want to really lay out for our listeners today of what consumer confidence through December really tells us going into 2025 about household spending?
I think it tells us that consumers, yes, they are curious, and there's a lot of uncertainty about policy in the US and what it means for their, the bottom line for them, for their pocketbooks. But still in all, they still think they're going to have the capacity to spend. And importantly, they think that their Even though the jobs expectations measure went back to negative, it's been generally negative for the most part of the last 2 or 3 years. Nonetheless, consumers remained employed and they continued to spend. So I think it's just that always that underlying fear of maybe I won't have a job. But in the short run, they're like, yeah, I can find a job. I'm working and I'm planning on spending as much as I can.
Absolutely. That is the situation we will all be tuned into. And for now, we're going to take a short break and be right back with more of my conversation with Dana Peterson.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm Mitchell Barnes, Labor Market Institute Head here at the Conference Board. I'm joined by Dana Peterson, Chief Economist and leader of the Economy, Strategy, and Finance Center at the Conference Board. Let's get right back to it, Dana. Let's continue with the conversation on the US. And I know that, really from some of the data we've made some material changes to the US forecast in December. Do you want to talk through those?
Sure, absolutely. So for our December forecast, looking out over 2025, well, the end of 2024, 2025, and 2026, we did actually make some pretty significant upgrades to the growth outlook. And most of that reflected the fact that consumers just continue to outperform. And as long as they have the inputs to spend, meaning they're working, real incomes are positive, real income growth is positive. Also, they still have some, savings. We learned that savings were much higher over the last couple of years after revisions, that they probably will spend. It's really about what could disrupt that spending. And certainly, a rebound or resurgence of faster inflation and higher prices could potentially weigh on that. But for the most part, we think that the U.S. economy grew by about 2.7% in 2024. Next year, around 2%. That's slower, but it's still sustainable. It's not a bad growth rate for the US. And it's actually pretty close to potential. But then in 2026, the US will probably grow slightly under potential, but still in all, a decent outlook.
And against that backdrop, and I know you've mentioned several times really the risk of stickier inflation being more persistent than really what we're hoping for. What is really behind that trend that we would see?
Sure. So we're definitely seeing that there's some elements of inflation that are just not giving up. And so the biggest thing, the biggest portion of inflation gauges are shelter costs. And shelter costs are slowing year on year. It's just not as fast as you would expect. And what are the expectations? Well, you can basically look at what home prices did and rents. Home prices did 18 months ago and rents did, 15 to 18 months ago. And both of those were slowing pretty rapidly. And so they have been doing a great job of portending what the measures in the CPI and the PCE would do, but it's not exact. And certainly the PCE and the CPI shelter costs are not slowing as rapidly. So that's kind of holding up progress. Also, you still have upward pressure from wages. Now, I know the Fed, says that there aren't, but when we look at the inflation, the wages data, they're still growing at a very elevated rate, 4%. Um, and we know that companies are passing those costs on to consumers and it's showing up as inflation. So is it as intense as it was a couple of years ago? No, but it's still there. And then there's also insurance costs. Insurance for a number of different things, housing, cars, health, they're all rising very aggressively. Some of that's related to demographics, some of it's related to cars are smarter and they talk to you, so it costs more to fix them and replace them. And also because many insurance companies are pulling back on where they're going to insure homes and also raising premiums for the people for whom they are covering. So those things are putting upward pressure on inflation. Um, Now, in the Fed's summary of economic projections, It's basically all the FOMC participants. So some of them vote, some of them don't. But they all put in there what they think the U.S. economy would look like, and some of them did actually fold in some expectations for policy from Washington, either trade policy or fiscal policy, and so some of that may include faster inflation, et cetera. For us, we included a little bit of that, some potential, but not a whole lot. But either way, we did raise our inflation forecast. We think inflation is going to get back to the target probably the end of next year. And that may actually be generous. And to that point, we think that the Fed will probably, well, they have already said they're going to indicated that they're going to cut rates only twice next year, not four times. We in the consensus we're around four or five cuts for next year, but that could definitely change depending upon what happens with inflation.
Yeah, understood.
So Mitchell, let me ask you a few questions since you're leading our Labor Market Institute, the conference board. How do you think the U.S. labor market's going to fare against all this? We have stronger growth, but stickier inflation. Consumers clearly think that right now it's easy to find a job, but they have some concerns about the future job prospects. So, what are your thoughts?
Yeah, we certainly see really the labor market continuing into 2025, really continuing its solid footing that it has been on, coming off the back of the robust hiring that we saw in 2022. I think really we need to really take account of where we're at. And I think a lot of the indicators right now throughout the labor market, whether they look softer than they did 2 years ago, I think is a little bit more relevant to look at where do they really compare to kind of 2019, 2017. And I think that is really kind of the range that we see the labor market in. And, as you had mentioned, we continue to see at least the present evaluation of consumers, their assessment of how plentiful jobs are to get ticked up again in December to 37% from just under 34% in November. And jobs hard to find is now sitting at about 15%, the lowest since May. So I think that does give us a little bit of optimism of what these consumers are seeing in the labor market. Obviously, going through those summer months, there were some data points that gave us a little bit of caution. But I think we really do see this holding firm, and certainly we would like to see hiring and some of these growth prospects pick up later next year.
Awesome. So you had a really amazing webcast, one of our best webcasts of the year on immigration recently. So just quickly, you know, if there are changes to immigration policy in the US next week, what's one or two effects that you might see in the labor market?
Oh, I mean, I think, this is a tough one to say, and I think we've received some clarity around the election outcome, but still, a lot of uncertainty to be sure around the actual policy specifics, and I would say, there are kind of two buckets on the immigration front that, I think we are really looking to. First being that enforcement, certainly we would see, tighter border security, some of the processing and things that I think have bipartisan support even. But I think deportations remain a big question. We know that a lot of these non-citizen workers make up critical workforces, agriculture, construction, cleaning, maintenance, food prep. Not only are these, kind of, large shares of the workforce, but I think really in the fight against inflation, against the backdrop of labor shortages, some of the things that we see, certainly this is a risk to the labor market. And I would also just kind of add in, I think it's a little bit less clear even what this incoming administration plans to do around legal channels. I think they have voiced, potential reforms, maybe opening up some of these employment-based options, but that would be a break from the first term. So I think it really remains to be seen really what path we go down and how quickly some of these changes come.
Okay, my final question for you, and then we'll do our, our lightning round back to me. Are there any other concerns you have about the labor market, or is there like upside risk to the labor market? What do you think?
Well, I mean, I think, the one upside risk, if there was one, is that we have seen, as you mentioned, kind of the wage pressures tick back up. I think we have seen labor shortages kind of be more persistent, really taking into account demographics, some of the immigration fight that might go on next year, that wage picture, might be the one concern. I think the overall story, though, of the labor market, for the past several months is that this is a great labor market if you're employed. Wages, continue to remain strong, especially against inflation that is continuing to fall. And I think, the concern going into next year is the job finding rate for those entering this labor market. This is a stage that has certainly been good to those that are employed or have found other opportunities. But those entering kind of at this late stage, I think it really remains to be seen, how active and this hiring environment can pick up going into next year to support some of those newcomers.
Thanks, Mitchell.
All right, let's turn back to you, Dana. And really, Dana, it sounds like going into next year, the US might slow, but we're still going to be okay. Would you say that that's a fair assessment?
I think so. That's the base case. There's certainly upside and downside risks. I think the risks are probably tilted a little bit more to the downside, especially if we have moments where there's cause for higher inflation or, changes in big reactions in financial markets to policies. But I think the base case of the US is still a positive one.
And which other economies are expected to lead the growth in 2025?
Sure, absolutely. In terms of contributions to global GDP growth, we think that's going to stay around 3%. China is still going to have a very large contribution, despite the fact that internally they're still challenged by very weak demand, the ongoing housing crisis, and trying to figure out how to bolster exports, especially in a world that's becoming more sensitive around trade. But still, in all, through a combination of monetary and fiscal policies, which have been intensifying, China's still probably going to grow, in around 5%, maybe just under it. And also, India is going to be a big driver of growth. They have their demographic. They have favorable demographics. I mean, they have a lot of young, educated workers. And also, ASEAN economies are probably going to do well because they're seen as another alternative for supply chains. So, after Asia in general, the US, but Europe is probably going to be a little bit weak. A number of economies will probably continue to grow, but there's going to be a lot of focus on Germany, and also in general, Europe is going to become more competitive, and doing that through introduction of industrial policies.
Mhm. And what are a few downsides to the risks that you see going into 2025?
Sure. I mean, the key downside is if we have a redux of trade wars, more political polarization within economies that causes upheaval politically, socially, that impacts their growth. Also, these hot wars and even the Cold Wars, and we may see at least pauses in some of these things, but it's not clear. And certainly, those have implications for supply chains, especially in commodities and critical inputs like computer chips and rare earths. So those are some of the big concerns that could lead to faster inflation.
Great. And to end on a slightly happier note, headed into the holiday season, what are a few upsides that you see going into next year?
Yeah, well, you could see, ceasefires or even ends to some of the global conflicts out there. I think, one thing that businesses can really play a huge role in is still focusing on productivity. And certainly companies are still investing in digital transformation, technology. They're looking at how to use AI, the latest forms of AI, to improve productivity of their workers and, at the end of the day, raise bottom lines and lower costs. I also think that you could see, potential downsides to inflation, not so much in the US, but elsewhere, especially where central banks have got out there faster to arrest inflation, and are at the point where they don't need as much restrictive this, and they've started cutting back the elevated interest rates, which can help bolster the economy, especially around interest rate sensitive areas.
Well, great. I think that leaves us with some optimism going into the holidays and into a great 2025. Dana, thank you for being here today.
Thanks. It's always great to be here.
And thank you all for listening to another C-Suite Perspectives. I'm Mitchell Barnes, head of the Labor Market Institute, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.